Question 11. Are there any limitations on the types of companies included in the index? Yes, the NYSE FANG Index does have limitations on the types of companies it includes. Here's a breakdown of the key factors that determine a company's eligibility for the index. Sector focus. The NYSE FANG Index focuses on the technology and internet/media sectors. Companies outside these sectors, regardless of their size or performance, wouldn't be considered for inclusion. Market capitalization. The index methodology likely has a minimum market capitalization requirement. Companies with a market capitalization that falls below this threshold on the reference date, last business day before the reconstitution quarter, wouldn't be eligible for inclusion. Liquidity. The NYSE FANG Index requires its constituents to exhibit a certain level of trading activity. Companies with low trading volume might not be included to ensure sufficient liquidity within the index. This ensures smooth buying and selling of the index components. Additional potential criteria. The specific methodology for selecting the 10 companies isn't entirely public. However, it's possible that additional factors beyond sector, market capitalization, and liquidity might be considered. These could include free float adjusted market capitalization. Only the publicly available shares, free float, of a company might be considered for weighting purposes, potentially excluding companies with a high percentage of restricted shares. Growth potential. The index provider, ICE, might favor companies with strong growth prospects within the technology and internet/media sectors, aiming to capture the innovative and high-growth segments of these industries. Financial performance. While not a primary focus, companies with a history of profitability or strong financial metrics might be viewed more favorably during the selection process. Comparison to broad market indexes. Broad market indexes, like the SP 500 or NASDAQ 100, have a wider range of eligibility criteria. They might include companies from various sectors beyond technology and internet/media, as long as they meet the market capitalization and liquidity requirements. Question 12. What are some alternative non-leveraged technology ETFs with similar exposure? Since FNGU is a leveraged ETN with a specific focus on the NYSE FANG Index, several alternative non-leveraged technology ETFs offer similar exposure to the technology sector, but with different risk profiles and characteristics. Here are some options to consider. Broad technology ETFs. QQQ, Invesco QQQ Trust, tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on the NASDAQ stock exchange. This offers broad exposure to the technology sector, including some overlap with the NYSE FANG Index holdings, but with a larger and more diversified set of companies. QQQ is a good choice for investors seeking broad technology sector exposure without the leverage of FNGU. DGT, Vanguard Information Technology ETF, tracks the CRSP US Large Cap Growth Index, which focuses on large cap growth companies across various sectors, with technology being a significant weight. DGT offers exposure to leading technology companies, but with a potentially lower concentration compared to FNGU and a more diversified holding selection beyond just technology. Sector-specific technology ETFs. SMH, VanEck Vector's Semiconductor ETF, invests in companies involved in the global semiconductor industry. While still a technology sector ETF, SMH focuses on a specific segment and might have a different risk-return profile compared to FNGU or broader technology ETFs. It can be a good choice for investors interested in targeted exposure to the semiconductor industry. IGV, iShares Expanded Tech Sector ETF, tracks the Dow Jones U.S. Technology Sector Index, which includes a wider range of companies within the technology sector compared to FNGU. This ETF offers exposure to both large-cap and mid-cap technology companies, providing a more comprehensive view of the sector's performance. Factors to consider when choosing an alternative. Investment objective: consider your overall investment goals and risk tolerance. Broad technology ETFs might be suitable for general technology sector exposure, while sector-specific ETFs offer a more targeted approach. Expense ratio: compare the expense ratios of different ETFs. Lower expense ratios lead to higher returns for you in the long term. Liquidity: assess the trading volume of the ETF. Higher liquidity ensures easier entry and exit from your investment position. Index composition: research the specific holdings of each ETF to understand the level of overlap with FNGU and the risk-return profile associated with the underlying companies. Question 13. Are there any actively managed technology mutual funds that could achieve similar results? Actively managed technology mutual funds offer an alternative to ETFs for investors seeking exposure to the technology sector. However, achieving results exactly similar to FNGU, a leveraged ETN, is highly unlikely due to the inherent differences in their structure and goals. Here's a breakdown of actively managed technology mutual funds and how they compare to FNGU. FNGU, leveraged ETN. Tracks the NYSE FANG Plus Index with 3x leverage, aiming to deliver magnified daily returns, both gains and losses, of the underlying index. Passive management strategy with holdings, dictated by the index composition. High risk profile due to leverage and concentration on a limited number of companies. Actively managed technology mutual funds. Invest in a basket of technology companies selected by professional fund managers based on their research and investment thesis. Offer the potential for outperformance compared to a benchmark index, like the NYSE FANG Plus Index, if the fund manager makes successful investment decisions. Lower volatility compared to FNGU due to the absence of leverage and potentially broader diversification within the technology sector. Higher expense ratios compared to ETFs due to the active management fees. Can actively managed funds mimic FNGU's results? Actively managed funds are unlikely to perfectly replicate FNGU's performance for several reasons. Active versus passive management. Actively managed funds don't have to strictly follow an index. The fund manager's decisions can lead to holdings that differ from the NYSE FANG Plus Index companies. No leverage. Actively managed funds typically don't use leverage, so they can't magnify daily returns, or losses, like FNGU. Focus on outperformance. While some actively managed funds might invest in some of the same companies as the NYSE FANG Plus Index, their primary goal is to outperform a benchmark, not necessarily deliver a magnified return that mirrors FNGU. Actively managed technology mutual funds, potential benefits. Potential for outperformance. Skilled fund managers might identify promising technology companies that aren't yet included in the NYSE FANG Plus Index, potentially leading to superior returns. Diversification. Actively managed funds can hold a broader range of technology companies beyond the 10 in the NYSE FANG Plus Index, potentially mitigating some of the concentration risk associated with FNGU. Lower volatility. The absence of leverage can lead to a smoother investment experience with lower volatility compared to FNGU. Examples of actively managed technology mutual funds. Fidelity Select Technology Portfolio, SELCS. T. Rowe Price Technology Fund, PRGTX. Vanguard Information Technology Fund, VGT. Note, this is also an ETF option discussed previously. BlackRock Technology Opportunities Fund, BSTSX. Question 14. What are the diversification benefits of FNGU compared to holding individual tech stocks? While FNGU offers some diversification benefits compared to holding individual tech stocks, it's important to understand that it's not a perfectly diversified investment. Here's a breakdown of the diversification aspects of FNGU. Limited diversification. FNGU tracks the NYSE FANG Index, which consists of only 10 companies. Compared to a broad market ETF with hundreds or even thousands of holdings, FNGU offers limited diversification. Concentration on technology sector. FNGU's entire exposure is concentrated within the technology and internet/media sectors. This means your investment is heavily reliant on the performance of these specific sectors. Diversification benefits of FNGU. Reduced concentration risk. While limited compared to a broader market ETF, FNGU offers some diversification by holding 10 companies instead of just one. If a single stock you hold performs poorly, it can significantly impact your portfolio. FNGU mitigates this risk to some extent. Exposure to established and emerging tech. The NYSE FANG Index selection process might include a mix of well-established technology giants and promising high-growth companies. This offers exposure to both ends of the technology spectrum. Benefits of diversification with individual stocks, if done strategically. Greater control and customization. By selecting individual stocks, you can tailor your portfolio to specific companies you believe have strong growth potential. Potential for outperformance. If you successfully research and choose high-performing stocks, your returns could potentially exceed those of FNGU, which tracks a passively managed index. However, significant drawbacks exist when building your own stock basket for diversification. In-depth research required. Selecting individual stocks requires thorough research and analysis of each company's financials, competitive landscape, and future prospects. This can be time-consuming and complex for many investors. Increased risk of portfolio concentration. Unless you build a very large basket of stocks, you'll likely still have significant concentration risk compared to a diversified ETF. Higher transaction costs. Frequent buying and selling of individual stocks can lead to higher commission fees and expenses compared to holding an ETF like FNGU. Question 15. Can FNGU be used for short-term trading strategies? FNGU can be used for short-term trading strategies due to its inherent characteristics, but it's a high-risk approach that requires significant experience and risk tolerance. Here's a breakdown of the pros and cons of using FNGU for short-term trading. Potential advantages for short-term trading. Leveraged returns. FNGU offers 3x leveraged daily returns of the NYSE FANG Index. This means that even small price movements in the index can lead to amplified gains or losses for short-term traders who can capitalize on these fluctuations. Volatility. The volatile nature of FNGU can present short-term trading opportunities for experienced traders who can identify and capitalize on short-term trends within the technology sector. Liquidity. FNGU generally has a higher trading volume compared to some individual technology stocks, making it easier to enter and exit positions quickly. Significant disadvantages to consider. High volatility. The very characteristic that might appeal to short-term traders, volatility, can also lead to significant losses. Short-term price swings can be unpredictable, and FNGU's leverage magnifies these swings. Decay of leveraged returns. Leveraged ETFs like FNGU experience decay in returns over time, especially in sideways or volatile markets. This can significantly impact short-term trading strategies if not managed carefully. Trading costs. Frequent buying and selling of FNGU to capitalize on short-term opportunities can lead to higher commission fees and expenses, eating into your potential returns. Psychological pressure. Short-term trading requires constant monitoring and quick decision-making. The fast-paced and potentially volatile nature of FNGU can be stressful for some investors. FNGU versus short-term trading on individual stocks. While FNGU offers some diversification compared to a single stock, it still concentrates risk within the technology sector. Short-term trading individual technology stocks can be even riskier due to the lack of diversification. Alternatives for short-term technology exposure. Short-term trading regular ETFs. Consider ETFs with lower leverage, e.g., 1, 5x or 2x, on technology indices if you seek some magnification of returns, but with less risk compared to FNGU's 3x leverage. CFD trading. Contracts for difference. CFDs are complex financial instruments that can be used for leveraged trading on various assets, including technology stocks and indices. However, CFD trading is highly regulated and might not be available to all investors due to its high risks. Alright chat ETF fam, that's the scoop on FNGU. So, can FNGU be your ticket to tech riches? The truth is, it depends. FNGU packs a punch with its leverage, but that volatility can be a double-edged sword. If you're a risk-averse investor, this roller coaster ride might not be for you. But for those with a long-term horizon and a strong stomach for volatility, FNGU could be a way to amplify your tech exposure. Just remember, diversification is key. Don't put all your eggs in the FNGU basket. No matter what path you choose, make sure you do your research and understand the risks before investing. Thanks for joining the chat, ETF fam. Leave a comment below and let us know your thoughts on FNGU. What are your favorite tech plays? Hit that like button if you enjoyed the video, and don't forget to subscribe for more in-depth ETF explorations.